Hi, this is video number 3 in our 3-part series on the 6 ways to pay the estate tax. In the last video, we went through the first 3. Number 1, liquidate cash and securities. Number 2, a forced sale of assets. Number 3, borrow and get a loan. Now here for number 4, it's the intra-family loan, and this is a little bit more unique to wealthy families with other privately held entities. It's known as an intra-family loan, and that's because it's an alternative to a commercial lender, and it's where you can obtain a loan from another family-owned entity to pay the estate tax due on less liquid type properties. Now, the advantage of such arrangement can be realized by the difference in the potential tax savings to the estate and the income tax due by the entity receiving the interest payments. Now, number 5. File for something known as the Section 6166 election. Now, this is a very specific, and it's only allowed under special circumstances which apply only for Section 66 elections, and this is where an estate may qualify for what's called a 5-year deferral followed by a 10-year installment plan. Now, the language of Section 6166 is quite strict into determining if an estate qualifies for an extension. Now also, the utilization of this option is complex, and the option to defer under 6166 applies only to owners of closely held companies when the values of the taxpayer's interest exceed 35% of their adjusted gross estate. Only the tax attributable to the value of the business may be extended under this section. Now, a word of caution here. A tax lien could be placed on an asset held in an estate until a tax has been completely satisfied. And this can inhibit the company's ability to obtain other debt needed in the regular course of business. This strategy also requires that the faith that the government will continue to provide this option for many years into the future, and as such, it may not be a reliable source of relief. And finally, number 6, purchase life insurance. This may often be one of the most efficient ways to fund a future liability at death. However, the individuals involved may need to prepare for it now, as premiums will certainly get more expensive the older you get, and it also requires that you prove insurability, and that could be an issue. Remember, life insurance enjoys a tax-free death benefit. The beneficiaries of a life insurance policy typically would have an immediate liquidity to pay the estate tax, thus eliminating the need to apply for loans, petitioning the IRS for relief, or selling off assets at an unfavorable time. Another reminder, in this ever-changing landscape of the Internal Revenue Code and its current interpretations, this should give you pause on relying on any one subsection. In dealing with tax uncertainty, diversifying your strategy may be the most prudent path. Also, utilizing assets like life insurance can be used as a good investment, should the decision ultimately be to use life insurance as one of the alternative solutions. As always, I'm here as a life insurance professional, an advisor, an agent, but you should also, of course, consult with your legal and your tax professional team when dealing with what is exactly right for you and your circumstances. If you have any questions about the use of life insurance to help pay for the estate tax, please reach out to me here at my website, pomfretfinancial.com. Thanks for tuning in.